The account size is one of the most important or one of the most significant factors that influence our approach to trading in terms of A, underlying selection, B, capital allocation, number of positions, C, strategy selection, and D, premium. We decided to do a Tasty Bites for today in place of Dr. Jim. And, Tasty Bites just means less than $25,000. So it could be over $2,000, under $25,000. Mm-hmm. And we have lots of new stuff going on. So like we have this Tasty Trade is an amazing application for small traders, because unlike other firms, we don't limit you to what you're allowed to trade on the platform. Like, we don't care. As long as you have the capital, you can trade anything. We don't have different levels like other firms.
Right.
So whatever you want to do, as long as you have the capital to do it, you can do it. And that's one of the really unique things about Tasty. We also just launched a brand new app called Bad Trader. And I know we're on a Bad Trader tour, and that's something completely different. But we did launch a brand new app called Bad Trader. It's in the App Store, and you can. It's a mobile app, and it's super cool. It's hosted by a bunch of college kids, and you can trade stock, options, futures, digital assets on it. It all goes through Tasty, so it goes right through your Tasty account. So if you wanted to listen to somebody talk about Errol Coleman, who's on the network all the time, who is really a wonderful kid. He's the host, along with Julia Spina, who, she did the Unlucky Investor book, and Julia's running the whole show there. They built along with our devs, a beautiful app. And this is geared towards, 18-year-olds, 19-year-olds, 20, 21, 22. And unlike other apps that are geared towards, teaching a 20-year-old how to save money, like Acorn or Stash or Mint or any of those things, completely different mentality on this one. We believe that 20-year-olds should learn how to take risk, should learn how to speculate, should learn, probabilities. We believe that 20-year-olds, screw all that passive stuff. We believe that when you're 20 years old, you should learn at that point, start learning how to take risks, start learning how markets work. So we support everything. We take a totally different approach to traditional apps geared towards young people. This has a bunch of college kids from schools like Texas A&M and Notre Dame and Davidson and Indiana, schools all over the country, kids from schools all over the country hosting this app. And I think you're going to find it really cool. I don't even know what that just was.
That was bonds you bought. That was a tick you didn't want to hear.
That was a tick
you didn't want to hear.
Oh, the 09s?
Mm-hmm.
Okay. No, it's fine. I did want to hear it. I don't put orders that I don't want to hear. So anyway.
I understand.
Anyway, we just launched it. We're just starting to tell people about it now. Julie will come on one day to talk about it in much more detail. But she's, she did a great job at the show this weekend. So anyway, let's go to the slides. So anyway, the reason I brought it up is because those are small accounts. That's what that Bad Trader's for. And so is Tasty. So let's go to the next slide. So underlying selections, that was part A. Underlying selections, smaller accounts are limited to relatively cheaper stocks, while bigger accounts offer more flexibility when choosing underlying price. Now that's kind of true, but you can also do defined risk trades on smaller accounts. So the beautiful thing about trading options is you can trade stocks like Tesla or Apple, anything. Let's just find some stocks that are super expensive. Netflix, Costco, $560 stock. You can do $5 wide, call spreads, put spreads, calendar spreads, whatever it is. So even with a smaller account using options, you can trade expensive stocks. But I think in terms of like naked positions and stuff, you're going to want to look at kind of some of the ranges that, what the capital requirements are. Remember, it's just under 20%. So if you're thinking about, hey, how much money am I going to have to put up to do this kind of spread, blah, 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 we threw some names down here that might fit for certain account sizes. Mm-hmm, okay, mm-hmm. Let's go to the next slide. So that's why trading naked strategies such as put calls and straddles and strangles and everything else becomes more difficult for small accounts due to the high buying power requirements. So we'd have a $10,000 account here, and we put some stocks in there that may fit, like Citigroup and Silver and VXX and UAL and Disney and Intel. No, I don't think Coke's that easy, but XLE and PayPal, they all kind of fit in there. And if you look at the 45 days to expiration, 30 delta short put, you can kind of see that we put the buying power requirements in there. Some of the things that may fit a small account, some of the things that may not.
Sure.
Again, this is just for, it's kind of like, hey, this is all, information purposes, as we say. A little AMC rally here, Bat.
The little things in the world that make you happy.
Huh? Yeah, we'll take our profits. It is.
I honestly hate it when you get like this. I mean, it's kind of like it's the worst day in the world for me.
Just scalping back and forth for.
Yeah, while you're sitting there doing nothing, Bat.
Yeah, while you're just sitting there, like,
There you go. I knew it was coming.
Cutting your nails and pulling your plug.
I knew it was coming.
Yeah, that's all. So the next one, strategy selection. So to generate more occurrences, because it's important to generate as many occurrences as possible to have a truly diversified portfolio, but also to achieve the expected outcome. So you can try, risk-defined strategies. And so we did down here is put call spreads, iron condors, and you can look at stocks that are more expensive, like SPY, which is a $450 stock, McDonald's, which is a $245 stock, or Disney, which is a $90 stock. And you can talk about things like, an at-the-money put calendar, a $7 wide iron condor, or a $5 wide put spread. And you can see the buying power requirement across the board, and you can see the percent of capital required to make those trades in a $10,000 account. So, I always say for defined risk, in a small account, you're going to be somewhere between 0.5% and 2 or 0.3%. And in a big account, you're going to be somewhere between 0.3% or 0.2% and 1 or 2% for defined risk. So all these kind of fit in the range. The SPY is a little bit outside it, but you can make that iron condor a little narrower so it fits in there. Let's take a look at the next slide. So capital allocation is the third one, and the number of positions. And the general principle is that the larger account we have, the less capital we should, on a percentage basis, dedicate to every position. In regular margin accounts, allocating no more than 3% to each position is the suggested rule of thumb, typically ranging from 1 to 3%. This is we're talking here kind of more around defined risk, but actually, let me take that back. What the research team is trying to do is to average defined risk trades with undefined risk trades and come up with around that 3% number. I think it can be as high as 5%, because you might, with a smaller account, like a $10,000 account, go up to 7 to 10% for undefined risk and 1 to 3% for defined risk. So it may be a little higher than 3 in average, like about 5. But again, it depends on what your ratio of defined risk to undefined risk is. For Tony and myself, it's like 80-20 or 75-25. But for other people, it might be, for smaller accounts, it might be 50-50 or 60-40 the other way, defined over undefined. Mm-hmm. Let's go to the next slide. So to trade expensive stocks with defined risk strategies or less expensive stocks with naked positions, we can boost our capital allocation to 5. Oh, they already wrote it here. To 5% per position with at least 5 to 10 positions in total. And again, when you're thinking about, like the total number of positions that you want to have on, but yet not use 100% of the capital, the reason it's so important is, again, for A, strategic diversification, and B, so that you create enough occurrences so that you achieve your expected outcome. Next slide.
Yeah, I mean, I know this is for Tasty Bites accounts, smaller accounts. This is what the audience loves. They love seeing these kind of numbers to let everybody understand where they should be. Because, listen, the only thing you can't change is your account size, right? I mean, you have what you have, and you have to work around that. And you also can't change. You got to remember that in this business, you can never change what the market's going to do. Like, mm-hmm. I talk about this all the time. We only can control that. This is in business. This goes for business. This goes for trading. This goes for everything. We only can control the things we can control. Mm-hmm. And, so we can control everything we do at order entry. We can, that's basically what we can't control what happens after order entry, after we're filled. Like, we can't control what the stock's going to do. So we can only put ourselves in the right position. on entry.
On entry. So this slide here is about premium. Again, since we have to stick to cheaper stocks most of the time, the premium traders can the premium traders can get might not be substantial enough to make a good return in the long run. So you got to be careful here. So like, for example, if you're, you want to put yourself in a position where the capital you're using is in that 3 to 7 to 10% range if you have a $10,000 account, but you have to make sure that the trade is worthwhile. Like Tony and I won't sell something for, I don't know, 50 cents or 25 cents. It's just not, it's not worth the risk. All right. So you'll.
Yeah, agree.
So in a stock like Intel, the example they used here was they did a 16 delta strangle, 20 delta strangle, 30 delta strangle, just to show you that, the difference in buying power and the capital required to make the trades, just so you can have something to kind of compare things along and look at it in just a format that makes it really easy to compare A, B, and C. Next slide, please. So as a result, we would love to get at least $1 in premium for any strategy. In order to achieve this, we can increase the individual risk, we can widen out the risk-defined strategy, or we can use a pricier stock. You'll figure it out. But you don't want to take too little money. Like when people write to us and they say, I sold a 1 or 2 delta strangle, we're like, okay, it's your money. You do whatever you want. We just build stuff to facilitate opportunity, but it wouldn't be something that we do. So we want to collect a little bit more money so we have something to, there's got to be a little bit of meat on the bone for us. There's got to be a little bit of risk in the equation. Last slide, please. So the takeaways. Trading in a Tasty Bite account may have some limits, so we need to adjust our strategy and capital distribution accordingly. Generally, it's wise to opt for more risk-defined strategies, increase capital allocation per position, and take greater risk with individual positions to potentially increase returns. And I also think with Tasty Bite accounts, it's really important not to have unreasonable expectations. Like you're not going to turn $10,000 into $1 million, or 2 million or 5 million.
Overnight too.
Yeah, overnight. I mean, we've had people, I did an interview with a guy, he started with like a little under $10,000. He turned it into 3 million. Can it be done? Yeah, of course. It's been done a lot. I did an interview with a guy just last week.
But it's the outlier move. It's not the norm.
Of course. Not only is it not the norm, it's like one in a million, whatever. Sure. Like I did an interview with a rising star last week that we're going to be publishing soon. He turned, $10,000 into 20,000, which he then ramped up and turned it into 60,000 or something like that. And it was a really nice story. And he did it through, but it took 5 years of trial and error and learning how to scale position. There was no overnight success. There is no such thing as an overnight success. I mean, there are cases you can count them on one hand in virtually every business where there's some crazy outlier. But, I mean, Tony Batista took him 40 years. Tom Sosnoff. It took me 40, literally over this size of the length of my career is, 40 some odd years. This is there's no overnight success here. I mean, we happen to have been successful in trading, from early on, but everything keeps improving over time. There is nothing easy. Nothing is easy.
Not even this show with you is easy. We'll take a quick 90-second break and come back. We got more Tasty Live after this with Market Measure. This is Tasty Live.